My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Willie Delwiche, who has got a nice following here. He's got a lot of interesting things to say when it comes to being tactical in this environment. Willie, introduce yourself to the audience. Who are you? What's your background? And exactly how ambitious are you to get both the CMT designation?
First of all, Michael, thanks for inviting me. Thanks for having me. And thanks to everyone for listening today. My background, graduated from college with an economics degree. Didn't really know what I wanted to do. Ended up in Milwaukee at a regional firm, R.W. Baird at the time. Now they just go by the name of Baird. Worked there for just over 2 decades as an investment strategist. Mostly focused on our PWM side of the business, some stuff on the institutional side, but most of it was geared towards advisors with a specific goal of helping them know what to do with respect to their clients' money in terms of where to put it, how active to be, things like that. Along the way, we developed a few tactical ETF portfolios that advisors could put client money into. So really it's a top-down approach, starting at the macro, looking at fundamental forces, looking at market forces, that sort of idea. Did that, like I said, for about 20 years. Spent a couple years after that then with JC Peretz and the team at All-Star Charts, doing the same sort of thing, focused again on giving guidance to advisors to help them know how to navigate what we're seeing in the world. Then earlier this year, launched Timeout Research, went out on my own. That's just a standalone effort at this point. But again, doing the same thing I did at All-Star Charts, doing the same thing I did at Baird, again, trying to navigate that space between just buying and holding forever and being so active that you don't know if you're coming or going. Also, then the fun extension to this is starting this fall. I'll also be doing a little bit of teaching at a local college, helping the next generation figure out how to think about economics, how to think about finance. So that's my background. In terms of the CMT and the CFA, I was at Baird. At the time, it was assumed that everybody in the research department would get their CFA. And so I went to the director of research at the time, and I was trying to figure out whether I should get my CFA or work on my master's. And he actually said, I do both of them at the same time. So that was the first trial by fire for me from taking on more than I thought I could handle. Did the CFA, then learned about the CMT and learned that maybe that would be a good way as well to kind of broaden the skill set. So after the CFA, then went back and worked on the CMT as well.
Is it fair to say that being an investment strategist, during those years was kind of easy in the sense that it was just about the S&P, or, were there a lot of kind of false signals or times when, from a strategist perspective, it looked like small caps would work or emerging markets would work, and still, momentum kept on going back to large caps? What was that experience like in the context of this kind of cycle?
Yeah. So when I started, I'd started in the fall of '99. So I mean, the first few years, and from a professional perspective, I saw the S&P 500 double twice. I saw it get cut in half twice. And so at the beginning, it was very much not an environment where you just got to trust large caps, got to trust the S&P 500. You had periods of tremendous emerging markets leadership. You had periods of tremendous small cap leadership. Now, over the past decade, it has been, quite a bit different than that, kind of that first decade, where, the past decade, it has been the moment you start to deviate from U.S. exposure and think about international, you start to lag. When you move away from large cap and start thinking about mid cap or small caps or equal weight approaches, you start to lag. And so this past decade was quite a bit different from that first decade that I was in the market. And that, I forget who said it, but those early experiences that you have in the market kind of form a lot of times your mindset on what normal is. And so seeing that sort of secular sideways period in the as I was coming of age in the market, I would be lying to say that didn't impact just how I think about the world.
Yeah, no, and I think that's important, right? Because you're exactly right. Your starting point is often the baseline through which you view the future. So and that's what's been, I think, so maddening about the sentiment that you now see on FinTwit, because a lot of newer traders came in, as the low was taking place, and it seems like from a sentiment perspective, everyone is just basing their view of the future based on up and to the right, because that's what it's been like, and then last year happened, staircase down. Let's get into that. Okay. So again, I want to go back to CMT versus CFA. Both are equally difficult in different ways. Do you find that because it's two different ways of looking at the markets that you lean more towards one way of looking at trading, investing than the other? And what do you do when there's disconnects? Because this will really get into sort of the debate around fundamentals versus technical.
Yeah, I try to be aware of both of them, and that's, I think, and then this gets a little bit ahead of it, but I'll say it right now. I think fundamentals are good for a long-term guidepost for where we could be going. The technicals do a good job of telling us what is happening. So which gets more weight, I think, depends on what your time frame is. If you're and what your desire to be active. If you don't want to be very active, then you probably need to have a longer time frame. And there, I think you need to place more weight on some of the fundamental issues. If you have a shorter time frame and are willing to adapt as things change, then maybe you can rely a little bit more from a technical perspective. I don't think it's really an either or, though. It really, it's the idea of fusion analysis, blending it together, just overall having a weight of the evidence approach that blends both fundamental influences and technical influences probably is the best way. That's easy to say from a macro perspective. I think becomes a little bit more challenging if you're thinking about individual stocks, things like that. And that's not, as a strategist, I am very much a top-down oriented. That's my approach. I do very little from an individual stock perspective, and so it really has to do with blending kind of the broader forces that describe what could happen from a fundamental perspective, but also being aware and balancing that against the what is happening actually on the ground, what we're seeing on our screens on a day-to-day, week-to-week basis.
So I think this is kind of an interesting way to frame it, because what is happening, I think, is conflicting, right? So I've made this point many times before, but like the argument now, for example, is breadth is widening, right? Mm-hmm. That's the narrative that you hear there. And that's true. I mean, more stocks have been hitting 52-week highs and all that. But that seems to be at odds with the fact that small caps are not really outperforming large caps in a really meaningful way. So there's a link between breadth and number of stocks, and there's many more small cap stocks than large cap stocks. So if breadth is widening, I would think a healthier breadth move would be one where there's outpacing of momentum in higher beta names, which you're not really seeing just yet. So when you have these kind of periods of cognitive dissonance in the marketplace, the question becomes, how do you interpret which is right and which is not, right? Which kind of gets into a discussion around the divergence.
One of the fallacies that we can, as anyone looking at a market, can fall into is this idea that they've got it figured out. It's this indicator that if we just trust the signal for this one indicator, it's going to work because we can show it previous times it has worked. And so there, I think, whether we're looking at it from a fundamental perspective or technical perspective or an overall blended perspective, that idea of multiple indicators, not so many that you can pick and choose and make the data say whatever you want it to say, but develop a set of relatively reliable indicators. And that at the end of the day, think about it like scales. And do you have more on one side or do you have more on the other side? And when it is mixed, I go back to the adage that, or I don't know if it's an adage or not, but it's something that I think about, that when the market's ready to go, it's pretty clear that it's ready to go. And so it shouldn't be this kind of waffly sort of in between mess, if it's going, it's going. And so if we don't have that clarity of signal, not that like everything lines up on the same side, but you pay attention long enough, you get a sense of if it's still a muddled environment or if it's actually trending in one direction or the other. And wait for that. Wait for those fatter pitch moments and not feel like you need to be fully invested all the time because, like you said before, last decade, it's been up and to the right. That's what people are used to. That's what they're expecting. Broaden out your history, and we've got multiple periods where we went a decade or more where it was just sideways nothingness and really frustrating for extended periods of time.
So that I'm glad you use that term fat pitch because oftentimes returns are not driven by consistency of small gains, but by missing, striking out, and then getting that fat pitch for the home run. Is there, if you were to look across the entire investment landscape now, where do you think the fat pitch is? I mean, clearly it was in NVIDIA and AI, right? I mean, at least in the short term, we can debate the fundamentals, obviously, and I'm very loud about my criticism there. But from a forward-looking perspective, what are you observing that could be a fat pitch?
Oh, geez, I don't think this is an environment where there's a good fat pitch, and so I understand that an investor's portfolio is made up of 100% of something, so you need to put it somewhere. But in terms of where would you put something now and expect that extended, kind of forever or extended move? I don't think this is a good environment for thinking about that. And so then if you're not seeing that, if I'm not seeing that, then I think it's a less is more. Like the fat pitch is having less exposure and not thinking about needing to be fully exposed all the time. So whether that that's cash or short term bond or something like that, I think that's from a parking space that's probably makes sense from a longer term perspective. Now, shorter term, things are moving, but it's not a set it and forget it. We're really set up for something fat right here.
Which goes back to the fat pitch. Okay, so I mean, I'll maybe. I mean, I think it ultimately goes back to distribution of returns for markets and kurtosis. Right? I mean, in terms of the tail risk. So we go back to fat pitch, where the fat pitch is just another way statistically of saying, a right tail or left tail kind of outlier type of move, right, on a relative basis. So, but it is interesting because I think it's true, Willie, that from a technical perspective, the things that you often see from technicians are you want to get, quick hits, make like what you see on FinTwit with 1% or just absolutely crush it, right? And it's like, that's not the way markets work, but explain why that's not the case, why that's not a valid way to look at markets.
Yeah. So I guess what I would, the way I would answer that is if in an ideal world, that's fine because you're going to pay the same amount of attention and execute the same way every single time. But the reality is that most people don't, most people can't. And so trying to kind of just accumulate those small gains, with a lot of activity in that respect, you're probably just better off buying and holding and not trying to look for the big trends. I think it comes to something that I think is important. It's not, and with spreadsheets, with data, we can make all these perfect systems, but they're not always systems that we can follow. And so the best system, the best model isn't necessarily the one with the best returns or maximizing this or minimizing that, but actually the one that we can consistently use. And I think we overestimate our ability to kind of follow a system that requires a lot of action over time. And I think part of that is just where we get distracted. We're in an environment where people that something happens and we move on to the next thing and forget what we were working on. And so I think a lot of the issue from my perspective is that overwhelming information, the distractibility of investors. And so, it's the same reason that, we don't always need another look at something. We don't always need more data on something. We need to simplify our approach, realize that additional data isn't necessarily our friend and can actually work against us.
So I want to go to the what I named the space fish in the DM that you sent me: tactical tailwinds versus secular headwinds. So I'll take it from at least my vantage point. Tactical tailwinds is an interesting way to frame it. I would argue that it's actually been somewhat challenging from a tactical perspective because, the worst environment for a tactical manager or trader is an environment where it's purely up and to the right because you get whipsawed playing defense based on whatever signals you're using. And I'd argue where you're in a very concentrated market because if you're tactically trying to go into something that looks like it's outperforming, it just doesn't want to stick. Right? Kind of, the worst environment in the world for anybody that's tactical is an environment which lends itself to more whipsaw.
Yep.
Right. Now I'd argue that actually could do a lot of that, but
Well, I don't know that it depends. If you get a lot of whipsaws, you can operate tactically in that environment as well. Most people don't. Most people think about trending rather than mean reversion. But I think your point about it being a challenging environment, I think it's true. When I'm saying tactical, I'm just thinking about a shorter term environment where we're starting to see, over the last few weeks, over the last month and a half or so, more price action that is more consistently bullish and maybe a little less whipsawy than what we saw in the early part of this year. You've seen some trends turn higher. You've seen better breadth. It's maybe not, checks all the boxes, but we've got more stocks making new highs and new lows. That's, an important development from my perspective. So that's kind of when I'm thinking about tactical, it's not thinking about it from a purely trading environment. It's just a little shorter term time frame.
Okay. So what kind of signals or things that you look at for entry, exit points in terms of the research that you put out?
Yeah. So in terms of what, I'd start with the weight of the evidence and that from a price and breadth perspective, that's bullish right now. So we've got some longer term price trends that are turning higher across the board, whether we're looking in the US, around the world. So I'm not trying to nail the specific entry. I'm not trying to nail the specific exit. I'm trying to be in harmony with the trend as it unfolds. So if the trend is turning higher, then we lean into that. If the trend is turning lower, then we lean against it. And right now, most of those trend indicators are turning higher now. And over the last couple of weeks, we've seen, like I said, more new highs and new lows on the NYSE plus the NASDAQ. We've seen an expansion in the number of sectors on the S&P 500. They're above their 200-day average. So it's not about specifically timing the entry and the exit as much as it is focusing on which direction the trend is going.
Yeah, and that makes sense. But just for sake of argument's sake, there's that line you often hear: the trend is your friend until it ends, right? But the problem, of course, is that nobody ever tells you when it ends until long after it already ends, right? It's kind of like everyone says trend falling, and most definitions are above a moving average. But sometimes people don't use that necessarily as their definition. So you hear these lines about go with the trend, but the inflection point's never really clear.
I think that is because most people change it's not just that different people have different definitions of the trend. I think people change the definition of the trend depending on what mood they're in. And this, I think this is one of the biggest issues with people looking at the market is that there's not a consistency of, indicators in their toolbox. They pick and choose the ones that fit with whatever their bias is going into this. And so
you just said it perfectly. No, you keep going with that because this is what drives me crazy about this.
So like you talk about, people talk about 50-day averages and 200-day averages a lot. And I'm not, when I talk about the trend work I'm doing, it's not that. It's not too dissimilar from that, but it's not that. But you can talk about whether or not the 50-day average is rising or falling, the 200-day average rising or falling, the 50-day is above the 200-day or is below the 200-day. All of these happen at different time periods. And probably if you stuck to one of them, you'd probably be okay as an indicator. You could back test it and figure out a way that it would work. The problem is that people jump around from which of those indicators they want to use so that they can be positioned however they wanted to in the first place. We look at it from a breadth perspective, new highs versus new lows. Some people look at peak and new highs versus peak and new lows. Other people look at whether they're expanding or falling. I like to look at it as whether there's more new highs than new lows or more new lows than new highs, regardless of what the level is. The key to it, though, is a consistent approach and not fitting your data or your use of the data to whatever your narrative is. So I think everybody can be evidence-based. It's whether or not you're consistently using the same evidence and changing your mind based on that, or you're picking and choosing the evidence to fit whatever mood you're in, from a starting point, and then just claiming that it's evidence-based.
Right. And of course, they're people get afraid of being accused of flip-flopping.
Right.
Right. And I always go back to, it's like, you're supposed to flip-flop because when conditions change, you're supposed to change. Right. I think the problem is, especially when it comes to social media, is the algorithm's not showing you a live line of thought in chronological order. So, and the evolving dynamics that happen because markets and probabilities change minute by minute.
Yeah. And also people aren't actually paying attention to what other people say. They're paying attention to what they think other people are saying. And so then then it's picking and choosing and not following kind of the course of conversation over time. It's you said this once, you said that once. I heard it as this, and so I'm going to accuse you of changing your mind, as if, like you said, like, changing your mind is what you do when the data changes. If you don't, then you're just stubborn and you're not really adding any value. If you are always going to be bullish or always going to be bearish, and no amount of data can change your mind, then you're not worth listening to, because whatever your comment is, it's always going to come back to bullish or bearish. When you're useful, it's you're open, you're adaptable, and you listen to what's happening. Otherwise, you're just saying the same thing over and over again with a slightly different veil on it.
I want to talk about sentiment. I shared it at the nest, but your observation around consensus bullish sentiment, highest since January of 2022. Now, two ways of seeing that, right? One is continuation of the bull trend because money's going to keep pouring in. But the other way I see it is, contrarian, time to bet the other way. Betting the other way, we should talk about, because I'm very loud against shorting as a way of betting against consensus and sentiment. But how much does sentiment factor into the way you look at markets and conclusions?
Yeah, so sentiment is one of the 6 factors I look at from a weighted the evidence perspective. It's one of the 3 market factors I look at. So market factors, it's sentiment, breadth, trend. Kind of the macro factors are liquidity, economics, valuations. So it's really important. What I think, though, gets missed in the sentiment discussion is the idea, and we've kind of just gone through this period, that once you have extreme pessimism, building optimism is actually the most bullish thing that can happen. You need bulls to have a bull market. You need people putting money to work after periods of excessive pessimism. That's what helps support further gains in the market. So actually you want to go with that sentiment trend until it reverses at an extreme. It's hard to find those turning points in real time. So you get thresholds and say, okay, if it's above this level, then that's typically as high as it goes. And so you want to at least be on alert, if not start to take more defensive action on the upside or on the downside when you start to see pessimism, get really excessive. Then you want to start looking for opportunity. But in the current environment, we had this slow build in optimism that I think was a healthy thing for the market. We saw optimism start to build after a lengthy period of pessimism. That's typically a tailwind for stock, because typically it means investors are putting money back into the market. Sentiment is only useful as an expression of what investors are doing. What they're saying, sentiment doesn't really matter as much if they're not accompanying it by action. So in the current environment, there's two things going on. One, we've moved very quickly through that. It takes bulls to have a bull market environment to now it looks like we've got more optimism than is healthy at the moment. But the other side of this, which is in some ways I think more fascinating, is that if you look at things from a positioning perspective, despite all the pessimism we had over the last year, investors never abandoned equities. You look at the AAI asset allocation survey. You look at the quarterly data that comes out from the Fed in terms of household exposure, stocks, bonds, and cash. And equity exposure has remained above average through all of last year, just off some of its highest levels ever. And so you don't have that room to have this build in optimism be accompanied by money being put to work, because frankly there wasn't much money on the sidelines through the course of the bear market last year,
which is certainly unique, I think, from that perspective. So, but to your point about until it becomes extreme or unhealthy. So it sounds like you think we're kind of nearing that, or maybe at that level now. So what do you do about that? I mean, some people will say it's a short, and I always go back to you have to be so spot on the timing. You actually want imperfect hedges, right? To bet against declining markets, because a perfect hedge means you have to get the timing perfect.
Yeah. So yeah, I'm not a big guy to think about shorting, and in large part because I'm trying to think about this from what a retail advisor is likely to do, or could do, and is likely to do in terms of helping his investor or helping his clients, her clients navigate the market. And so, and I don't think shorting is the best solution. I mean, I think it's more about just holding cash and sitting on the sidelines, waiting for those better opportunities where opportunities tilted, the risk return is tilted more in terms of return and less in terms of risk. And so I think that as we see optimism build from it's a little bit of a challenge because it's different. Excessive optimism behaves differently than excessive pessimism. But at the same time, if you've got a slightly longer term time frame, you don't really want to be fully exposed at a time when investors are super optimistic and they already have elevated exposure to equities. One of as in the work I've done, one of the best indicators for future returns for stocks is, equity exposure at the beginning of a period. And so periods with elevated levels of equity exposure tend to be followed by very subpar periods of return. Periods of low equity exposure tend to be followed by, very, very above average periods of stock market returns. And so right now we've got this double whammy of increased optimism and positioning that an investor level fare with equities that, really got solidified over the last decade as stocks could do no wrong. It's still there. And so just from that mix of sentiment and positioning suggests to me that this is a high risk environment. It doesn't mean we need to crash. It doesn't mean we need to, go back to what we saw last year or start to see, replays of some of the worst markets in the world. I mean, it could happen, but I think a more realistic focus is just preparing investors for a different environment than we've had over the past decade, where up and to the right was this recurring theme. I think we're much closer to the early 2000s or, the 70s where it was this lengthy sideways market, as some of that deeply embedded optimism that expresses itself via above average exposure to equities actually starts to get worked out through the system.
So, okay, you mentioned cash. What about just, kind of more traditional sector rotation, right? So I've noted that utilities relative to the S&P are getting back to the level of November 2021 before the bear market started. Utilities kind of your quintessential defensive bond product, right, within the stock market. any kind of how much of your work is related to sector rotations in general?
Yeah. I mean, I look at sector rotation. If I do a fair amount of work with relative strength rankings from a sector perspective. It's not going to be. We could think about it in two respects. One, if you have a choice between stocks and cash, and you have a high risk environment, moving out stocks and into cash is probably one way you can play it. If you have a mandate or a desire to stay fully invested in stocks, or whatever your remainder that you didn't move to cash, you still have in equities, focusing on some of the lower beta areas of the market, the more defensive areas of the market, I think makes sense. We can look at extreme readings in terms of ratios, various sectors versus the market, various sectors versus each other. Right now, from a relative strength perspective, we're not seeing defensives in any sort of leadership. So from my perspective, now is not the time to do that. But as a systematic approach, sector rotation and or asset allocation rotation probably give you some, a similar result in that you're reducing your equity or reducing your exposure, becoming lower risk. And I think that is the right approach right now from a long-term perspective.
Yeah. And that sideways point, I'm glad you mentioned, because I mean, I know it sounds crazy, but until to me, you've broken out of the prior high, which I know we're getting close to, obviously on equities, right? You're still in the drawdown. If you're still in the drawdown, that may mean you're still in a bear market. You don't know.
Yeah, I mean, that's a good point that you make. That everyone's talking about these 20% move, 20% down, 20% up. Like it just in real time, you don't know until you make that high and make the new high. And the other side of that is I think it was in the late after the peak in the late 60s. Peak in terms of household equity exposure, you actually had a very brief higher high in the S&P 500. And so even there, you can make that slightly higher high, but still be in this broadly sideways environment. And I think now I'll just go back to, we get so caught up because we're able to, with such specificity, as we're dealing with stuff in real time and we're applying that then to history, that we lose the shape of the bigger picture moves. And it's that shape that really matters. And so you go through a decade of sideways, you go through a decade of very little downside and a lot of upside. That becomes the norm in terms of people's expectations now, is that that's what persists. I don't think we need to worry about whether we make a slightly higher high or not. I think preparing for the idea that we could be in a broadly sideways range where you'll revisit levels and keep revisiting levels that you're at now, 3, 5, 7, 10 years later. That's the important shape that I think we need to pay attention to, not some of was it a 19.9% move or now it's 0.%, so it's a bull market things like that. I think that's a good way to get distracted. And like I said before, the world is full of distractions. Investors are constantly getting distracted and losing focus.
Let's talk about the fundamentals for a bit, since I see a few references to earnings, your feed and other things there. Where are we from a fundamental perspective? Meaning, are things looking healthy, better than expected, just from a company-specific perspective? I'm going to make the assumption that, again, it's a mixed bag, just given the pure performance differential, large to small. But fundamentals should ultimately trump everything longer.
Yeah. So from a fundamental perspective, we've had short term. The economy hasn't been as bad as people feared. So you have this economic surprise index that's like at a 2-year high or something like that. But that's not a long term indicator. That's one of the noisiest mean reverting things that's out there. From a fundamental perspective, it's headwind for equities. Liquidity is declining. Liquidity is the lifeblood of the market. We've got almost every central bank in the world, not China, not Japan, but pretty much, even Turkey now is raising rates. So that's a headwind for equities. The Fed is drawing down its balance sheet. That's a headwind for equities. Bond yields now are providing some competition for equities. At the end of June, the 1-year Treasury yield was higher than the forward earnings yield on the S&P 500 for the first time in 20 some years. So there's real competition from a valuation perspective. The economy, it's getting credit for not falling apart, but it's not. I don't see it as strong as those who want to cheerlead it make it out to be. We had retail sales data earlier this week. Going back to where we were at the end of 2019, where we've seen 3% annualized growth in real retail sales from that point to now. Going back to early 2022, we've seen 3% annualized decline in retail sales. So it's not we had this immediate kind of post-COVID surge, but a lot of the economy, a lot of real economy stuff has been moving sideways at best now for a while. Employment is okay, but that is an outlier in this environment because of some of the secular issues with the labor force. So I don't think that's as useful an indicator in this environment as looking at what's happening from an income perspective, from an earnings perspective, from an activity perspective. And then just from a quarterly data perspective, for the last 5 quarters have seen either a decline in real GDP or a decline in real gross domestic income. That's not the sign of a healthy economy. So I think from a fundamental perspective, it's a very shaky foundation, especially if you then go back to and at this point, everyone loves stocks, everyone hates bonds. It's really, really historically imbalanced at this point.
Yeah, and the positioning on the bond side shows that if you look at the CFTC net speculative short positioning on long duration treasuries, I mean, it keeps on getting even more extreme. I mean, I had used that line before. It's like you're the mother of all short squeezes in treasuries, which hasn't happened yet. I mean, selfishly, I want to see that because that's designed to they're designed to try to benefit from a flight safety dynamic. What happens in treasuries, but it is interesting. The longer term headwinds, aside from fundamentals, how much of that is just based on risk in terms of credit? So I keep on floating this idea, and I've said this from the start of the year. I think the melt up year, but there's a credit event out there because you do have a lot of loans that are going to be refinanced at higher rates next year. If you believe the markets are a discounting mechanism, it should start to respond off of that this year at some point. But do you foresee that there's going to be some stress in the credit markets?
It would be beyond reasonable expectation to see rates go from 0 to above 5%, for short-term rates, and then whatever secondary, tertiary moves you get elsewhere, for there not to be some sort of blow up. We're seeing this generational shift in the trend in bond yields, I think, and the market still is not believing that has happened, and 2, that's going to persist. And so that probably doesn't happen until after you get some sort of kind of risk blow up. There were some hints of that out of the banks in California earlier this year. That didn't happen, didn't manifest itself. That would have been a little too. Each cycle is an echo of the previous cycles, not a repeat of the previous cycles. So it would have been a little too neat if it happened because of some bank. I think there's probably something else out there. What it is exactly, who knows? But the market is, equities are moving along, assuming or acting like we haven't had this massive tightening in yields, and it's still assuming that even after this massive tightening, we're going to get relatively immediate relief in terms of this quick pivot from the Fed and then the beginning of lower rates. I don't see that happening, and the longer yields stay high, the more we're at risk of some of this fragility coming to the surface. I agree with the premise that there's probably more risk out there than the market is acknowledging. But I think that stems from a disbelief that we've made an important turning point from a yield perspective.
Yeah, I think that's a good way to frame it. And then, obviously, the yield curve still is sending massive warnings in and of itself, separate from credit spreads, right? So it goes back to the earlier part of the conversation. We're in an environment, there's a lot of cognitive dissonance going on from multiple asset classes.
Yeah. And I think the important, I think the reason for that is that we're at a pretty important turning point. Equity investors for the past decade in the US got used to up and to the right. Like we've said, that's been the reality. So they're acting as if that reality is still in place. Bond investors are, it's 40 years of lower lows and lower highs in terms of yields. That started to change. And so I think from both an equity perspective and a bond market perspective, we're at these critical turning points that in hindsight, I think history will say, yeah, that was an important time period. We made an important turn. But as it happens, and this goes back to your earlier point about identifying trends in real time, it's a challenge to know that past paradigm has faded and that we're in this newer paradigm and we need to adjust our behavior accordingly. There's two risks in the market: assuming that you're not in a new paradigm, and the risk that you are in a new paradigm. I think right now it's people are assuming the past continues and that we haven't made this important turn. I think a lot of the evidence suggests that we are making this important turn.
Willie, for those who want to track more of your thoughts and take a look at your research, where would you point them?
You can follow me on Twitter at Willie Delwiche. You can also go to himountresearch.com. It's HIMOUNT research.com. You can find High Mount Research on Substack as well, posting stuff there. So those are probably the three best places to keep track of what I'm thinking, what I'm saying, what I'm doing.
A good place to wrap this Twitter space up. Everybody, please make sure you follow Willie Delwiche here on Twitter, and hopefully I will see you all later. And stay tuned for the podcast version coming out shortly. Thank you, Willie. Appreciate it.
Yeah, thanks a lot, Michael.
Cheers, everybody.